Taxation in Vietnam is governed by laws and regulations issued by the government, primarily the Ministry of Finance and the General Department of Taxation. Vietnam's tax system is designed to support economic growth, encourage foreign investment, and provide public services. This guide offers an in-depth overview of Vietnam's essential taxation aspects for corporate and individual taxpayers. It includes the latest updates and key regulations for 2024. Content of the Guidance of Taxation in Vietnam. First, the corporate income tax. Corporate income tax, standard rate is 20% for most businesses. Preferential rates with lower rates, e.g., 10%, 15%, are available for certain industries or investments in economically disadvantaged areas, such as high-tech or renewable energy sectors, tax incentives, exemptions or reductions for projects in priority sectors, special incentives for companies operating in economic zones or high-tech parks. The default tax, financial year in Vietnam is from January 1 to December 31. Enterprises can, however, elect to adopt an alternative tax, financial year in certain circumstances, where the alternate year ends on either March 31, June 30, or September 30. Tax losses can be carried forward continuously for a maximum of 5 years after the loss-incurring year. Carryback of losses is not permitted, and there is no concept of group loss sharing or consolidated tax relief. Foreign investors are permitted to remit their profits annually after the FYE or upon termination of the investment in Vietnam. There is no withholding tax on dividends paid to corporate shareholders, and a 5% withholding tax on dividends to individual shareholders. Value-added tax, goods and services, including goods and services, purchased from foreign sources, used for the purposes of production, trading and consumption in Vietnam are subject to value-added tax, VAT. VAT methods. There are two methods for declaring VAT, the deduction method and the direct method. First, deduction method, VAT liabilities are calculated by offsetting input VAT with output VAT, and second, direct method, VAT liabilities for each specific goods and services are calculated by using the specific VAT rates. Deduction method is applied when the company maintain Vietnam accounting system compliant accounting records, invoices and supporting documents in line with prevailing regulations. VAT payable, creditable, under deduction method equals output VAT, input VAT. The VAT tax rate are 0%, 5%, 10% or exemption based on the specific industries. Direct method is applied for business, household or individual, specific cases regulated by law, or those who do not register for the deduction method. VAT payable under direct method equals turnover x tax rate, which tax rate are 1%, 2%, 3% or 5% based on the business industries. VAT declaration and payment. The VAT declaration and payment terms depend on the turnover of the taxpayers in the previous year. The taxpayers who had a turnover of more than VND 50 billion must declare and pay VAT on monthly basis. The taxpayers who had a turnover of less than VND 50 billion can opt for either monthly or quarterly VAT declaration and payment. The deadline for the monthly VAT declaration and payment is the 20th of the next month, while the deadline for the quarterly VAT declaration and payment is the last day of the next month after the quarter ends. E-invoices are compulsorily required from July 1, 2022, onwards for all the entities, companies in some economic sectors, such as electricity, petrol, telecommunication, natural water, credit institutions, insurance, medical, e-commerce, supermarkets, trading, transportations, etc., can use e-invoices without verification codes. Other companies can also use this type of e-invoice if they meet certain conditions. Otherwise, they must use e-invoices with verification codes. Before using any type of e-invoice, companies must register and get approval from the tax authorities through the web portal of the GDT. Foreign business organizations, with or without a permanent establishment, PE, in Vietnam, that have income derived from Vietnam from contracts entered into with Vietnamese parties, or undertake business in Vietnam, are subject to CIT and VAT applied on payments. Combined, these tax obligations on payments are referred to as Foreign Contractor Withholding Tax, FCWT. There are three different methods that can be applied by foreign contractors in respect to calculating FCWT. Point 1. Direct method. The direct method is the most common method, and does not require any specific conditions to be satisfied by the foreign recipient. The applicable rates for the direct method are based on specific business industry. Point 2. Deduction method. The deduction method requires foreign organizations to register for VAT in Vietnam, and to file VAT and CIT returns in the same manner as local Vietnamese entities. And 3. Hybrid method. The hybrid method allows foreign organizations to register for VAT in Vietnam and file in the same manner as local Vietnamese entities, however CIT is paid on the direct method rates based upon gross turnover. Both the deduction and hybrid methods require the foreign organizations satisfy the following conditions. 1. Having a contract duration in Vietnam of 183 days or more. 2. Having a PE in Vietnam, for example, a project office. And 3. Maintaining accounting records in accordance with the Vietnamese accounting system. Tax rates. The FCWT rates vary depending on the nature of the income. Typical rates include services, CIT 5%, VAT 5%, total 10%, royalties, CIT 10%, no VAT, interest, CIT 5%, no VAT, goods, delivered with on-site services in Vietnam VAT 5%, CIT 1%, filing deadline. FCWT must be declared and paid within 10 days from the date of payment to the foreign contractor. Late declaration or payment may result in penalties, including fines and interest on the unpaid tax amount. Documentation should also be maintained in a manner that is sufficient for lodgement and declaration with tax authorities and banks, as lack of documentation is often grounds for denying foreign payments. Special Consumption Tax, SCT, in Vietnam is a form of indirect tax imposed on the production, importation, and consumption of certain goods and services deemed luxurious or potentially harmful. The SCT is regulated under the Law on Special Consumption Tax and its implementing guidelines. Tax rates. Applicable SCT rates for specified products and services are listed in the table opposite. These rates apply to the selling price, exclusive of SCT, Environment Protection Fee, if any, and VAT. The tax authorities can adjust the taxable price if they think the selling price does not reflect the market value. The taxable price of imported goods at the time of importation is the sum of the dutiable price and the import duties. If a trading entity sells manufactured or imported goods to entities that are not independent, a minimum taxable price may apply in some cases to prevent tax avoidance. Tax credits, where goods subject to SCT are produced with raw materials that were already subject to SCT, the manufacturer can claim a credit for the SCT paid of the corresponding portion of the raw materials. Personal income tax. Individuals earning income in Vietnam are subject to personal income tax, PIT, in Vietnam, based upon their tax residency status. Employment income is taxed on a progressive rates basis while other income subject to fixed tax rates. Tax residency. Vietnam tax residents are taxable in Vietnam on their worldwide income, whilst non-tax residents are only taxable in Vietnam on their Vietnamese-sourced income. A tax resident is an individual that satisfies one of the following: a. resides in Vietnam for 183 days or more, within 12 consecutive months from the first day of arrival, or 2. In a calendar year, b. holds a Vietnam temporary or permanent residence card for Vietnam, or c. leases a property for a term of 183 days or more in Vietnam in a tax year. If the above criteria are not met, then an individual will be treated as non-tax resident in Vietnam. However, care still needs to be taken, as there are circumstances where an individual may still be deemed a tax resident in Vietnam if they cannot prove they are tax resident in another country. Tax year's finalization. For employment income, employers are required to withhold PIT from employee salaries and remit monthly or quarterly, depending on the size of the employer. Individuals will need to determine whether they will need to undertake an annual tax finalization to ensure that their tax finalization matters are in hand where necessary by the deadline of PIT finalization. If an individual only has income from a single employer during the year, or other income in limited circumstances, then they can authorize their employer to finalize on their behalf by the last day of the third month from tax year end, i.e., March 31st, if an individual wishes to claim a tax refund or has a tax liability to the tax authorities, then they must complete a tax finalization by the end day of the fourth month of the following year from the year end, i.e., April 30th. Individuals with simple tax matters, and who do not owe any taxes to the authorities or have tax payable is less than VND 50,000, do not need to finalize. However, this may have an impact on future years if their tax affairs become complicated. Therefore, all taxpayers are encouraged to finalize their taxes each year. Personal income tax rates and other incomes are presented as opposite tables. Personal relief of VND 11 million per month, and dependent relief of an additional of VND 4,400,000 per month for each dependent. Individuals commonly enter into service contracts in Vietnam for short-term activities, but as these are not treated as labor contracts, PIT will not be applied on the progressive scale. Instead, payments exceeding VND 2 million in a month will require 10% PIT for tax residents to be withheld and remitted by the paying entity, the company, as a prepayment of PIT for the individual. At the end of the year, this income will be included in the annualized/taxable income subject to PIT at progressive rates, and a credit will be given for the 10% already paid. Any shortfall in taxes will need to be paid to the tax authorities upon finalization. Compulsory insurances. The maximum cap is the maximum salary at which insurance is calculated. Earnings above this cap are not included in insurance calculations. These caps are based upon minimum basic wage, and change as mandated. Minimum basic wage change. The unemployment insurance cap varies depending on the zone of the employment. The displayed calculation is for Zone 1 employees. The highest minimum zone insurances withheld from employee gross salaries are deductible for PIT, i.e., not subject to tax, and the employer contributions are not regarded as a taxable benefit for the employee. Foreign employees are exempt from unemployment insurance. Minimum monthly wages zones are designated by the government. For example, Zone 1 covers areas including urban areas of Hanoi, Ho Chi Minh City and Hai Phong, along with certain industrial areas of Binh Duong and Dong Nai. Non-taxable benefits income. Although the definition of taxable income is broad, there are certain defined benefits that are excluded from taxation. These benefits include once per year round-trip airfares for expatriate employees returning home, or Vietnamese working abroad returning, school fees, excluding tertiary, for children of expatriate employees or for Vietnamese working abroad, mid-shift meals, subject to a cap if provided in cash, one-off relocation costs for expatriates coming to Vietnam for employment, and for Vietnamese working abroad, uniforms, subject to a cap if provided in cash, benefits provided in kind on a collective basis, e.g. memberships, where an individual is not identified as beneficiary, allowances or benefits for weddings or funerals, Additional income that is not taxable includes interest earned on deposits with banks and credit institutions, payments from life and non-life insurance policies, retirement pensions paid from the Social Insurance Fund, transfers of property between direct family members, inheritances and gifts from direct family members, monthly retirement pensions from voluntary insurance schemes, income from winnings at casinos, for employment income paid by the head office to employees working at dependent units/business locations in different provinces. The PIT withheld for these employees will be paid to the provinces where the employees are working. Double tax agreements. Vietnam has entered into comprehensive double tax agreements, DTA, with more than 80 countries, with a number of other DTAs agreed but not yet in force. Refer to the table on the following page for a summary of current DTAs. Vietnam's DTAs provide relief from double taxation on income. The application of CIT rules, for example, may be impacted by a DTA whereby the 5% CIT portion on services provided by a foreign contractor may be eliminated where the foreign contractor does not have profits attributable to a permanent establishment in Vietnam. Tax relief in Vietnam under a DTA is not automatic. Foreign taxpayers are required to submit a notification application to the Vietnamese tax authorities 15 days prior to the tax payment deadline in order to seek to apply double taxation relief. Applications can still be submitted in arrears up to 3 years from the tax payment due date, however implications may arise with late filed applications. Transfer pricing in Vietnam is an important area of tax regulation, particularly for multinational companies operating in the country. The Vietnamese government has implemented strict transfer pricing rules to prevent tax base erosion and ensure that intercompany transactions reflect the arm's length principle. Defining related party relationships. Associated parties are: a party is directly or indirectly involved in the management, control of, contribution of capital to, or investment in the other party. Party are directly or indirectly affected by the management, control of, contribution of capital to, or investment in the other party. Transfer pricing methodologies. Entities that are deemed to be a related party are required to maintain documentation to support their chosen methodology for arm's length pricing. Methodologies that can be used include comparable, uncontrolled price, cost plus, profit split, comparable, profits and resale price methods, which are consistent with OECD guidelines. Transfer pricing documentation. Documentation compliance requirements for transfer pricing include a 3-tiered approach: I. Master file, 2. Local file, 3. Country-by-country report. These documents have to be prepared before submitting the year-end CIT finalization, and the transfer pricing documentation in Vietnamese version must be available for authorities to inspect. Relief from transfer pricing documentation requirements. Entities can be exempt from the documentation requirements under transfer pricing legislation, although the other provisions will still apply, where an advance pricing agreement, APA, has been agreed with the local tax authority and an annual APA report is submitted to. The entity has revenue in Vietnam below VND 50 billion, and the total value of related party transactions are below VND 30 billion in a tax year, or 3. The entity has total revenue below VND 200 billion, performs simple functions, and achieves one of the following ration of earnings before interest and tax: distribution, 5%, manufacturing, 10%, processing, 15%. Interest expenses. CAP for tax deductibility, for companies subject to transfer pricing obligations, total loan interest expense for a tax period, after excluding interest from deposits and from lending, that qualifies as deductible expenses for CIT purpose cannot exceed 30% of the EBITDA. Non-deductible interest expenses can be carried forward to the subsequent 5 years. Vietnam's implementation of the Global Minimum Tax, GMT, involves a mandatory minimum tax rate of 15% for multinational enterprises, MNEs. This tax rate targets MNEs with global revenues exceeding €750 million, $812 million, in at least 2 of the last 4 fiscal years. The scope of this framework is designed to encompass large corporations that have traditionally leveraged low-tax jurisdictions to minimize their tax obligations. Central to Vietnam's GMT framework are the Income Inclusion Rule, IR, and the Qualified Domestic Minimum Top-Up Tax, QDMTT. The IIR is a mechanism that requires ultimate parent entity, partially owned parent entity, intermediate parent entity, directly or indirectly owns an ownership interest in low-taxed constituent entities located in other jurisdictions under the GLOBE rules at any time during the fiscal year to pay the difference between the effective tax rate paid by its subsidiaries and the 15% minimum rate. If the subsidiaries' tax payments fall below this threshold, the QDMTT complements the IIR by allowing Vietnam to impose its own top-up tax on domestic subsidiaries of foreign MNEs if their effective tax rate is below 15%. This ensures that Vietnam captures additional tax revenue domestically before it is collected by the parent company's home country under the IIR. The QDMTT helps maintain tax equity and retains fiscal benefits within Vietnam, supporting national development goals. The time limit for submission of declarations of QDMTT, top-up tax enclosed with a written explanation for differences between financial accounting standards and payment of top-up tax is 12 months after the end of the fiscal year. This table is a summary of compliance requirements for ease of tracking. The implementation of the Global Minimum Tax, GMT, will significantly impact multinational enterprises, MNEs, that have benefited from Vietnam's corporate income tax incentives. These incentives have traditionally allowed many MNEs to enjoy effective tax rates below the new GMT threshold of 15%. As a result, these companies will now face higher tax liabilities, which could affect their cash flow and profitability. Tax administration: the standard tax year is the calendar year. However, different accounting year-ends can be used if approval is obtained from the authorities. Tax returns: the annual final CIT return and the audited financial statements must be filed no later than the last day of the third month as of the ending date of a calendar year or a financial year. Tax payment: enterprises are required to make quarterly provisional CIT payments, no later than the 30th day of the next quarter, based on the quarterly business results. The total provisional CIT payment of 4 quarters of a tax year must not be less than 80%, 80% rule, of the total CIT liability for the year. Any shortfall will be subject to late payment interest, counting from the deadline for payment of the quarter 4 provisional CIT liability. Final payment of CIT is due with the final CIT return, i.e. the last day of the third month as of the ending date of a calendar year or a financial year. Tax audit process: tax audits are carried out regularly and often cover a number of tax years. Prior to an audit, the tax authorities send the taxpayer a written notice specifying the timing and scope of the audit inspection. Statute of limitations: the general statute of limitations for imposing tax is 10 years and for penalties is 5 years. Where the taxpayer does not register for tax or commits evasion liable to criminal prosecution, the tax authorities can collect unpaid tax and penalties at any time. Thanks for watching.